We will call this meeting to order. It's now 2:39 or so. We'll call it 2:39. And we'll go ahead and we believe we have a quorum. If there's any issue, we're going to check with our attorney to make sure we indeed are interpreting right that we have a quorum. If there's any issue, we will repeat the motions sooner rather than later. We wouldn't wait 3 months since there's a list of retirees. So we'll do it now and then check it out. First order, called order, let's see, election of chairperson, vice chairperson, and secretary. I'm currently the chair, Mark is the vice chair, and Carol is the secretary. Would entertain any motions or nominations.
Do we have to do them individually, or can we just make one motion?
It can be one motion.
Yeah, I'll make a motion that the board stays the same. The president, or what is it?
Chair, vice chair, and secretary.
Chair, vice chair, and secretary stay the same.
Okay,
Jason.
that's Jason. Is there a second?
I'll second that, John.
Okay. Any discussion? If not, all in favor, say aye.
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 Thank you. That passes. Public input and board communication. Do we have any members of the public with us? If not, any board communications beyond what's already been sent out for our pack today? Okay, moving on. Finance director report. Slowly trying to keep it busy.
Hello, everyone. Nice to see you all again. I believe that Lori had emailed you out all the copy of the December 30th. This is well, it's the first quarter of the calendar. It's the second quarter for our fiscal year. And you'll note that as of December 31st, it was the gain loss had risen from 1.2 million to 6.5 million. We do had in the December quarter, the December quarter reflects many of the admin expenses that the fund incurs that were not part of the September, which is like the SCI fees, Hooker and Holcomb, and also the audit. The pension payments are just your monthly pension payments for 6 months of the year. Return of contributions only increased slightly. And then the reconciliation at the bottom is from taking the report from SCI to get to the town of Groton's number. So if anyone has any questions, I'll try to answer them for you.
Nope, no questions.
Okay.
Thank you.
Yep, thank you. Moving on to approval of the November 18th, 21 minutes. Hopefully everyone had a chance to review those. And whenever ready, I'd accept a motion.
So move. This is Mark.
Second, Jason.
Okay. We have a first and a second, and any discussion? If not, all in favor, say aye.
Aye.
That's approved. Moving into authorization of payments from retirement fund for retirement benefits. And we typically do this as one motion.
So moved. This is Mark.
Second it is Jason.
I have a motion and a second. If there's no discussion, all in favor, say aye.
Aye.
Motion approved. Now we're up to SCI. Welcome.
Thank you. I have John Waite with me here as well, but I'll go through the main part of the presentation. We don't have any recommendations today. That will all really depend on other conversations we have at this meeting. But I'll go ahead and looks like I can share my presentation here.
Yeah, and can you get, oh, there you share it. So we'll see the page number. Yeah, I'll check it out.
I'll try to follow you.
I can't remember.
Okay, can everyone see that okay?
Yep, got it.
Okay, wonderful. So again, this is kind of just the executive summary here. We'll get into detail about the markets for last year and a little bit of an update through January. We had some volatility in January, as you're all pretty aware of. But obviously, the main objectives of this plan are just to continue to grow the funding status. Obviously, in order to do that, we need returns in excess of the actuarial assumption rate of 7%. The good news is, for long periods of time, we've exceeded that considerably. So that's really kind of added to the overall funding status of the plan. This is just an executive summary here. You can use it for your meeting minutes, but I'll touch on all these in detail as we move forward through the presentation. So we ended the year last year on a pretty good note overall. The fourth quarter was a little muted. We had pretty flat returns across the board, with US leading the way. You can see the indexes on the right-hand side here. For the fourth quarter, US large caps, small caps, and developed international had positive returns, where fixed income was mixed. The longer duration bonds you had, the higher returns in the fourth quarter. And then commodities actually were negative for the first time in a while. So commodities were the big winner for the one-year period. And we'll talk more about that as we move through the presentation. But the main theme was in the fourth quarter, Omicron creeped into the scene, and obviously that had impacts. What's going to happen next? Are we going to have more mandates? Are we going to have more quarantines? Is it going to hurt small businesses? So that all came back into play in the fourth quarter, and that's why we saw returns kind of some volatility in that fourth quarter. Moving ahead to the US equity side, which again has been a top performer with the exception of commodities, which was the best performer last year. It's been kind of a mixed scene between value and growth. The bottom left-hand chart, you can see it was pretty even for the year and actually not too far off for the quarter, growth won for the quarter. But what we're seeing with these sectors on the bottom right-hand side, we're seeing a lot of rotations within sectors, right? So going back the last 3 to 5 years, we saw big tech companies kind of pulling all returns higher, pulling the S&P 500 higher. Well, that's changed, and it really changed in January, which I'll touch on in a minute. But we're seeing these sectors rotate back and forth from the left side to the right side, which is good because what that means is company fundamentals matter again. Corporate earnings, they matter again. And we're seeing a lot more of that. So that also means active management is coming back into play because if an active manager is picking good quality companies based upon their earnings, they're going to benefit from that in this kind of environment that we're in today. So the left side, energy was the big winner for the 1 year. That kind of goes along with the commodity story. Real estate followed suit, and then financials. So that's kind of new, right? Financials are more value-oriented securities. They did very well for the 1 year period. Technology is kind of more towards the middle now, where that was always on the left-hand side of the chart. So all in all, we're seeing some rotation, which is good. We're not just seeing, 5 to 10 names really driving the markets higher anymore. Within international equity, emerging market equity struggled somewhat towards the end of last year and for the whole year, frankly. The main reason is vaccine. They just didn't have the vaccine amounts that they needed in order to really kind of get down the numbers of the spread of COVID. So that was a big drag in their economies. Inflation is also impacting emerging markets as well as currency. So they were the big loser last year, but overall, Europe and the US held up pretty well on a 1 year basis. And the US and Europe for the fourth quarter as well, they were kind of the leading asset classes. China really struggled last year. There's a lot of things going on with China right now with their zero COVID policy, which we talked about last meeting. 10 people in a city of 5 million get COVID, they lock down the entire city. So that's a big deal. We're seeing with the Olympics right now as well. You kind of get a taste of that, what's going on there. But all in all, we saw good returns across the board. Emerging markets was the worst performer within the international equity front. So fixed income, there's a lot to talk about here. It used to be the most boring subject because rates were always low and they never moved. What we've seen is rates go up. If you look at the 12/31/2020 light blue dotted bar, that's where we were just over a year ago. and the bar has moved up across the curve. And what we've seen more recently is, as of 12/31/21, we saw the short end kind of move higher, expecting higher rates, possibly more Fed rate increases, and the longer end of the bar kind of flattened out a little bit. So with that being said, last meeting, we were kind of expecting maybe 2 to 3 rate hikes. Now we're seeing some organizations say anywhere from 4 to 7 rate hikes, which is kind of hard to believe. I think 7's on the high end. But it wouldn't surprise me if we see inflation continue to run rampant the way it has. We could potentially see maybe not a 25 basis point rate hike, but maybe a 50 basis point rate hike in March. So that's just something to keep an eye on. Inflation has been a big issue. So in 2021, inflation climbed 7% in the US. That was the highest since 1982, which is a long time ago. And I don't know if you remember the early 80s, but back then mortgage rates were around 18.5%. We had CDs were trading from 15 to 16%. You could get a short-term CD for that amount of interest, but the flip side is the interest eating away on all that purchasing power. So, but it was pretty incredible time period. And, so that really covers, there's one more point I want to make there. And okay, so CD rates, yeah, no, so that's it there. Any questions around that? Because, that's pretty meaningful, rates potentially moving that high. Obviously, that's going to have impacts to the fixed income side of your portfolio. Some things we have to think about along with Ken, as the next meeting, we're really targeting allocation changes. That's one thing that's going to be in the back of our mind as we go through that process, after we go through more of a discovery period as to what's going to happen in the rest of the meeting today. Any questions? We do think equities have a little bit more room to run this year. Obviously, we favor international over the US now. I mean, that's easy to say because the US valuations are just so much higher than the international valuations, depending on where you look. And we do favor value in this environment, specifically in a rising rate environment where, financials tend to do well in higher interest rates. So that's just one category, but many others as well. Okay, so I pretty much touched on all these. Again, just something for your notes. One thing I didn't mention is obviously geopolitical tensions with Russia and Ukraine. That's obviously a big issue that could, we've seen oil prices and natural gas prices spike considerably. Just with that news, they were already spiking prior to that, but it could, obviously if they invade the Ukraine, that's going to have some global implications as far as supply chains, specifically natural gas. So here's the good news. As of December 31st, the portfolio returned 13.4%, 13.21% net of fees. We did outpace the index slightly there, so that's good news. And you can see the longer term trend. I mean, we've had good outperformance and very strong absolute returns with the portfolio we've had. Again, more of that kind of indexing type strategy within the large cap and small cap space, as well as international. I'm sure you're questioning what happened in January. So what we saw was Facebook sold off about 20% in one day. Their earnings came out, their usership went way down. So that's just one example of there's more focus on corporate earnings. And then a couple days later, Amazon blew the earnings out off the charts and they were up about 20%. So there's a lot of focus on earnings. But all in all, if you look at January, value outperformed significantly. So if you're in more defensive sectors in January, you did a lot better. Obviously a lot of these companies are a large part of the S&P 500 index and large cap indexes. So when a company like Facebook goes down 25%, you're feeling a good brunt of that within the index. On a year-to-date basis, as far as the funds, I mean, the index funds obviously are going to be right in line. Your large cap index, Vanguard, small cap, 600 index, Your Fidelity International Bond Index, pretty much in line, outperformed a little bit there. Vanguard Emerging Markets, obviously that was the lowest returner that underperformed the index. A lot of that probably had more to do with probably had a little bit of an overweight to China, which caused that underperformance. And then within core fixed income, we saw, here's the negative returns I'm talking about. So within core fixed, it has a duration of around 6, which means, I'll give you an example. So if interest rates go up by 1%, again, this is an estimate, it could go down 6%, right? So, and vice versa. If interest rates go down by 1%, it could go up 6%, just as a simple example. So you did see core fixed income was down 1.27%. For that particular strategy. Now, the good news is, even though it's a small allocation, you did have high yield bonds. They were the best performing asset class last year. So that was up over 10% for last year. So that helped a little bit on the fixed income side and muted the overall negative returns as a result of rising interest rates. Real estate had a fantastic last year. And we saw that in the previous page that I showed you. So returns of 45.5%. That's a very good, strong, absolute return there. That really added to the portfolio as a whole. This is just on a calendar year basis. You can look through this at your leisure. But that's all I had for now.
Hey, Pat, can you real quick question. Oops. Can you talk a little bit about how you rebalance, like when you have real estate, going off the charts and having that kind of year? How often do you rebalance? What's the process of that?
Sure. We populated a white paper on this. So we moved to quarterly rebalancing. And what we do is if any individual fund is outside of plus or minus 2% variance, we sell that off. For instance, if real estate's moves up to 5% or 5.5%, we'll sell that off, and then we'll buy the funds that underperform. So essentially, we're selling high, buying low by using that process. And we also do smart rebalancing too. So with cash flows coming in and out, we look at the portfolio to see where the targets are, and there's things that underweight. We'll potentially buy more of those than we would the overweight instruments.
So the 2% is applicable for all of the assets, whereas large cap equity having a 37% allocation, if it's that range would still be 2% plus or minus, as same as real estate. Okay.
Yep.
All right.
Any other questions?
Not?
Okay, that's all I had.
Okay, thank you. Appreciate it.
Thank you.
Next up, Sageview.
Okay, I'm gonna share my screen
Sure.
if I can.
Good to see you, Ken.
Good to see you. Thank you. Let's see. Everybody see that?
Yes.
Okay, great. So I'm just gonna quickly, hopefully quickly, echo some of what Patrick was saying. The good news again, 2021 was a great year. The investments that you have all passed the investment policy screens and criteria. So everything's passing from that perspective, looks good. The focus, I think, really is, where do we go from here and what lies ahead? And so kind of the first chart is inflation gets ugly. And if you look at the top part of this chart, you can see again, starting in, kind of early part of 2021, we started to see that tick up in inflation. And then it really kind of escalated in the fourth quarter, October, November, December, culminating in a 7% inflationary rate. If you fast forwarded to today, the latest one was 7.5%. As Patrick correctly stated, worse inflation than we've seen in 40 years. Just as an aside, my first house we bought back in the early 80s when interest rates came down from 18% to 12.5%, which we thought was a steal at that point. So we're not quite there yet, but again, the question ultimately is, what is the Fed's response? And, and will it be a couple of rate hikes, or will it be as high as 7 rate hikes? And, I'm not sure everybody or anybody knows the answer to that. Some comments, obviously spooked the market. Market opened up today, Dow was down 300. News came out, was actually positive in a short period of time. Some news came out about what interest rate policy could be, and that spooked the market, and Dow went down about 500 points, at some point in the day. So I think we're likely to see that level of volatility across the board, in 2022. As we see it on the next page, if you look at the top line, the S&P 500, since 2019, which includes, the quarter of pandemic starting, or at least 2020 did, 31.5% in 2019, 18.4% in 2020, and almost 29% in 2021. That level of performance cannot continue indefinitely. There are cycles to the markets. And the question is, ultimately, what's the catalyst that changes the market from positive to negative? What cycles that market? Likely to be inflation and the response, of higher interest rates that ultimately do that. And the question ultimately is, how does that impact on companies' earnings, which is again, Patrick correctly stated, ultimately should drive, the price of a stock, the growth of those earnings. These are some of the scoreboard criteria factors that we think influence, where the markets go. And we've labeled, on the positive, corporate earnings, the housing market, which has been exceptionally strong, manufacturing, which has been strong, trying to rebuild back inventory. And on the negative side, certainly inflation, interest rates, and trade tensions. Any of those factors can flip on themselves, and a negative can become a positive can be a negative over the course of time, depending on the circumstances that go on. And I think this is one of those years in which we're not quite sure exactly where things are going. As the markets try to price out what's going on, and they look like 6 months ahead, trying to figure out, what will the economy look like six months from now? They're trying to figure out, is it two interest rate hikes? Is it 7? Is it 50 basis points in March? And again, as news comes out, I think that ultimately drives that volatility of the market. So we're likely going to see that. Could be a difficult year, certainly on the fixed income side, as interest rates rise for returns on that. And, depending on what happens with earnings and the economy and the growth of the economy, ultimately where will equities lie? Do they have some more room to go, or is this the year that they start to pull back? And then, as again, Patrick said, is everything even, value, better than growth? One of the interesting things, if we look at, the price earnings ratios of value stocks versus growth stocks. So how much do you have to pay for a stock versus what those earnings drive? You can see in the upper right-hand portion of this chart, that large value and small value have price earnings ratios that are in the teens, whereas large growth and small growth, have very, very high price earnings ratios, even higher than sort of a 20-year average that we see, right below that. So it seems like growth stocks are pricey at this point in time. Value stocks look like they have some quote unquote value associated with them. How does that ultimately play out? And, where do the markets go? So again, only point here is that we're likely to see volatility this year. It will be harder to get those kinds of returns that we've seen in the last 3 years. And, we'll be interested to hear Bill on the actuarial side, talk about, how this has played out from an actuarial standpoint, and what happens if, in fact, the markets don't necessarily cooperate with us. And then again, the yield curve is, again, Patrick pointed out, you look at that 10-year number at the end of last year at 1.5%, higher than it's been. But a historical perspective, if we look back 3 years from then, so the 2018 numbers, that 10-year yield was about 2.7%, 2.75%. So we still have some room to grow there, or room to go. And again, ultimately, what does that, as we drive towards that, what impact does that have on the returns that we see, both on the equity and the fixed income side? Questions on that? Again, a lot of it was just repeating what Patrick said, but I think it's important to sort of put things in perspective in terms of where we may be going in 2022. Okay, just real quick, I just wanted to again highlight the performance of the funds. Again, we look at the right-hand column for all the funds. Everything's in green, meaning that as we score out the investment criteria laid out in the investment policy statement, everything has a passing score for all of the funds. We'll continue to look at that on a positive basis. When we score the funds out collectively and we kind of rank them amongst comparable funds in similar situations, we're looking at a score of 13. The lower the number, the better. Again, so these scores are very high. So again, the performance of the individual funds have done well. As Patrick said, we look at the return collectively, much higher than the actuarial return. Certainly in the last few years. Hopefully we can continue that going forward. Any questions? That was all I had. So again, we'll certainly pipe in discussions on the actuarial valuation and certainly pension obligation bonds. So John, I'll hand it back to you.
Great, thank you. Appreciate it. We'll move into the pension obligation bond discussion.
You want to do that one before the report, John?
Oh, they're listed. So yeah, go ahead, do that first.
You want the report first or the bonds?
Let's do the report.
Okay.
I think it makes sense to do the report first. Yeah.
All right. Can everybody see the screen?
Yes.
Okay.
Yes.
All right. So we'll highlight we'll talk about the report. These are the years we always like to talk about, especially, when assets perform very well, usually the news is pretty good that you can give to the employers or their plan sponsors. So it's always a good time. So first we'll kind of hit on the purpose of the valuation, just to kind of give you a refresher. Remember that we're trying to come up with a way to measure or to determine a cost to fulfill the requirements that the plan has promised to participants. You're going to pay someone out, maybe $10,000 a year. That's going to be the true ultimate cost of the plan. So you want to kind of figure out how to get to that point. And what's the town's cost? The town's cost tends to be, you got to pay the benefits you're promising, less any expenses, plus expenses. And that's going to be offset by the investment return as well as employee contributions. And always the key thing that we always like to see is the bigger the investment return, which is what we've had this year, means the lower the town's ultimate cost is going to be in the future. So that's always a good thing. On the bad side is those other years that we happen, like in 15 or something, that you have the assets don't do so well, and then the employer contribution tends to go way up, and that's not a good time to be talking with you guys. So what did the valuation do? We kind of come up with a cost method to kind of approximate what those, how to kind of measure, how to account for the benefits that you're going to pay in the future. So we do that, and just to determine, so you guys can budget appropriately each year what that's going to be. And that contribution is what we call the ADEC, or the Actuarial Determined Employer Contribution. And that's really made up of two pieces. One piece being, amortization of any unfunded liability that hasn't been fully funded yet. And the other piece is the normal cost. And that's the normal cost tends to be the benefits that are earned each year. So those are the key two components. One of the things to remember that this year we did for the amortization, we implemented a layered amortization approach. Prior to that, it was, you had a closed amortization that was going to go down each year, which also means each year your payment could grow bigger. And that kind of, by doing a layered amortization approach, we kind of do intergenerational equity, so that the benefits earned are kind of being accounted for the people that are earning them, that why they're there and part of the plan. And it also helps you can see what's happening from year to year. When you do plan changes or assumption changes or losses for each year, you can kind of see what happened each year over time. So let's talk about kind of what happened in this past year. One of the key things that we did was we lowered the long-term rate of return assumption. That was 7.25. We dropped it down to 7%. That's probably still a little high, but that you're moving in the right direction. So that kind of drove costs up a little bit. Another key change that we made in assumptions, and that kind of happens every year, is that there's a new mortality improvement scale. And this year was the first year over the last half a dozen years that actually increased liabilities. So these two changes, they increased the liability by $4.4 million. And that's kind of the change, increase in your unfunded liability that much. Most of it, again, was due to the interest rate change. That was
Just a quick
4.16.
comment about the assumption changes, Stefan.
What's that?
Just a quick comment about the mortality improvement scale.
Mhm.
The results, we're assuming that it's going to improve each year. And the last few years, people, there was some mortality improvement, but not as much as we thought. So this year went in the other direction. But this year is the last year before COVID starts getting reflected. So they're behind in their data. So we would, it'll be interesting to see what happens with the next year's mortality improvement projection. So
And to Bill's point about the COVID, how the impact, they're saying it's really going to take probably 2 to 3 years before you see the full effect of what that does. Nobody knows right now. Everybody's trying to figure out how to measure it, how to account for it. It's very difficult because it's such a moving target. You don't know from day to day, from month to month, how it's really affecting the plan overall population. But we will expect that to be another 2 years, probably 2 to 3 years. Well, you'll start seeing bigger changes in that improvement scale each year.
Yeah.
So,
the other thing I saw in the news the other night was, I'm trying to remember the fellow's name on CNN that was talking about mortality, about there was 40% more mortality between the 18 to 64 age group. And so, everybody was like shocked at that. But, for us, when we think about those numbers, if you have 10,000 people and there's a 0.5% chance of somebody dying during the year, well, that's 50 people passing away during the year. And then if that increases by 40%, your 50 people goes to 70 people. So while it sounds like a big difference, when you talk about, those small numbers, it's really not anything to get excited over. So I did see that thing on the news, and I was wondering if anybody else had seen that as well.
the other thing you got to remember that, as mortality decreases due to COVID, other things, mortality is probably increasing because you're not doing some of those riskier things, or surgeries aren't happening. A lot of other things aren't occurring as much, right? During the pandemic, everything was shut down, so you didn't have people traveling as much on the road. So you probably had a lot lower car accidents and things like that. So, it's a whole big thing and a lot of moving pieces in there, and how they're going to overall measure that. Anyway, moving on, the fourth bullet, we did have a mild loss overall in the liabilities to the plan. That could be due to salary scale increases, salaries more than expected, retirees retiring with benefits a little higher than we would expected, people living longer than expected, so things like that. And that was just about $1 million, a little over $1 million. However, the flip side, and that both Patrick and Ken had talked about, assets did very well, right? We had we had huge gains on the asset side of over $4.66 million, right? And so that gave us a net gain to the plan of over almost $3.6 million. So that's a good thing. That's going to help out. That helps out. That kind of relieves some pressure on the contribution requirement as well. So what we saw gains on both the market and actuarial value basis, right? Because usually, the market value. Remember, I think to point out that there's two different things we look at. The market value is kind of what Ken talks about and Patrick talks about. But then for evaluation purposes, we smooth assets to kind of limit some of that volatility, right? So, it's really good in those years that assets don't perform well, but you tend to not like it as much in the good, strong years, right? Because you don't get to reflect all of those gains all at once. But anyway, AVA still earned over 11%, market over 25.5%. So that's a good year. And remember, we are smoothing assets over a 5-year period. So that kind of means that we have quite a substantial amount of built up gains. So after gains of assets, that ended up being over 448,000 right? That's the increase to the ADEC, right? That's the decrease. On the flip side, the assumption changes increase the ADEC by $572,000, right? And again, that has to do with the mortality as well as the interest rate being the bulk of that. And then you have a little bit of increase in the contribution due to the liability losses of 104,000. So those kind of other components that make the contribution go up and down. Overall, the contribution just changed it went up a little bit, about $300,000. Again, that is due to the bigger change in liability due to the discount rate change. So on this last bullet, kind of as I mentioned, you have $16.93 million built up of asset gains that have yet to be recognized. So what does that mean? Each year, you're going to recognize another 20% of those gains, and that'll help put some downward pressure on the contribution in the future years. So for instance, if you kind of lower the discount rate again next year, that will really be offset by when you recognize these gains, right? Because the gains are going to increase the asset value, right? Because right now the market value is a lot higher by the 16.9 million, higher than the actuarial value. So they're going to get, that means, and we measure liabilities against actuarial. So that means assets are going to be going up in the next few years. And overall, when that's fully at $16 million gets fully recognized, your contribution could go down by up to 1.6 million after 4 years, right? And that's about $400,000 a year. So those are things that are going to help you next year and the next couple of years. But again, that could be kind of diminished a little bit by liability losses as well as any asset losses, right? But you still have that built up. It doesn't go away. All right. The next slides are kind of informational stuff. This is just kind of showing the components of measuring that gain or loss. You know, we expected the unfunded liability to be just under $30 million. It came in at 26 million. So that accounts for that $3.5 million decrease in liability. On the flip side, so this second to last line is the assumption changes that increase it by 4.4. So overall, that's about another $800,000 increase that you have to measure, and that's why you have that contribution went up just slightly. Here we show you kind of development of the actual value of assets. Like I said, the key component here is this chart in the bottom shows the 5 years of losses, gains and losses that have yet to be recognized. So here you can see this number in the bottom right corner is almost $17 million. So that's what you're going to recognize next few years, right? Because up top here, the market value is 153, actuarial is 136. So that means your assets are going to eventually move up, and that's going to shrink that unfunded liability. For the record, you do measure on GASB, your accounting, when you do your GASB reports, that does measure on the market value basis. So that shows you the true funding kind of on a market basis. Here's just a quick chart kind of showing you the rates of return. Again, you can see the red is what the impact of smoothing assets, and you know you don't get much volatility, much shifting of the numbers. You know, it's been hovering 5 to 10% over the last 8 years, whereas the market value in the purple, that you can see it's down under 5% the first couple of years, 15 and 16, and it went over to 10%, 17. Then it kind of was at about 7% the last 2 or 3 years. And then you see the big jump to 25% this past year. Again, remember, we're taking a snapshot as of 6/30/21. Pat and Ken are talking about more up-to-date numbers, but we're using this snapshot because this is when we measure liabilities against the assets to come up with that contribution. Here's a visual interpretation of just the liability against the assets. The difference between the purple and the red is that unfunded piece. It's been pretty consistent. You know, it hasn't really grown much. You know, the last 2 years it's kind of grown a little bit. Again, for this past year, really the liabilities kind of shot up again because now we're measuring at a lower investment return, so a lot lower discount rate. So that's why it kind of shot up a little bit. But the assets also shot up. So you know the overall gap is still roughly the same. It just kind of shows you the funded ratio, right? You know, it's been, again, the smoothing kind of shows you there's not much change in the red, which is based on the actual value, but on a market basis, you can see you're over 90% funded on a market basis. And again, this is what gets disclosed in your GASB reports. For funding, though, we fund on the red. This page just is showing you the development of your contribution requirement. So you have again, one of the first key component is normal cost, right? And a couple pieces that make up the true normal cost is the gross less the employee contributions plus admin expenses that are added. So that's the true town cost each year. This next, the other component is the amortization of the unfunded liability. That's just 2.8 million. And you can see it's gone up a little bit just because, as I said, the investment return assumption kind of changing increased that liability a little bit more. So overall, your contribution is now 5.1 million versus just 4.8 million for the prior year. So this is the contribution you're budgeting for the 22-23 period of time. Okay. Here's just this. The next two pages are really the detail of that contribution by group. This is more internally for internal budget purposes. So how they allocate cost to each group that's involved in the pension plan. These are all the town groups. We won't get into details here. We have the Board of Ed on top and the fire groups, and the total is the 5.1 million. And that's so it all comes up nicely. And again, the town uses that internally. Contribution trends. This one doesn't look. This chart, kind of shows how your contribution's been growing right over the last 8 years. Back in 17, it was only under $3 million. Now it's just over 5 million, right? And that's just because you expect the contribution, the normal cost to always kind of go up each year, unless the plan's closed to new entrants, just because they're accruing additional benefits each year and the pay is going up. So overall, just kind of thinking of inflation or however that you want to look at that, everything kind of keeps moving up in the same direction. The reds is kind of what we're trying to get this piece to be a little smaller, right? Because we want the plan to be better funded. But as assets grow as well, your funded levels basically stayed the same. It's just your contributions bigger now.
So something else for you to think about, the purple level, the normal cost, that's really your future service cost. And the orange level is really your past service cost. And you've also seen us refer to it as the amortization of the past service liability. So those are your two portions of the cost: future service cost, past service cost.
This is just kind of a snapshot or a summary of everything, all the key components. Your membership overall increased 9 people. So you expect your liability to have grown a little bit, right? Active population down a little bit, but I'm guessing their salary obviously went up about almost 2.5% overall. Again, that's why the normal cost kind of gets a little bigger. You can think of the actual present value future benefits. This is the total amount of money you'll eventually pay out. These are all the benefits summed up. 167,000 is kind of where you are currently in that. So you can expect another 31 million for the current population that isn't been realized yet. Again, assets. And here, what you can kind of clearly see, last year the market value was just slightly ahead, higher than the actuarial value by a little over $1 million. Now it's much bigger, right, as opposed to being a deficit. So that means when the AVA is bigger, that means you have unrecognized losses. When the AV is smaller, that means you have unrecognized gains. So that just means you're going to get some relief in the next couple of years on your contribution requirement. Unfunded liability increased, like I said, just about $600,000, just under that, about 550, 600. Funded ratio actually improved, even with the drop in the rate of return.
Yeah, that's a great thing when you can lower the return and improve the funded ratio. That doesn't happen all the time.
usually it goes down 3 or 4%.
Yeah.
So it just shows you that you did have a very strong year on the asset free side.
Hey guys, quick question. When does inflation and wage growth start impacting on your assumptions here?
We do, but we don't look at inflation short term. We kind of use, and I've been doing this for several years, and I've kind of gotten built to kind of go along with it. We look at the Social Security report, the trustees report that they put out, because they look at inflation over 70, for 70 years. What's longer term, right? Short term is not what, if your plan was closed and very mature, you might look at, a different way. But because the plan is open and you expect it to be around for 50, 60, 100, the next 100 years, unless something else changes, we want to look at a long-term assumption, right? So if they come back and say it's going to go up, then we likewise move that up as well.
Okay.
Right. So for instance, the past year or so, when we asked for capital market assumptions from different investment firms, I've seen them go from like 1.5 to about 2.25 in the last year or two, right? But Social Security uses 2.6 or 2.4. So in this current valuation, we're using 2.4. So ours is a little higher than what you guys had been using. Again, that's probably not going to be 1.5, 2%. That you guys might change that in your capital market assumptions in the next year or two. Again, you guys probably constantly look at that. Again, but you're also looking at a much shorter term. So you have a little bigger impact of that.
Yeah, so when we do our funding, we're looking at a 2.4% increase in salary plus another component for merit increases. And that's, if you want to look at your valuation, it's on page 37, I think, of the valuation report, talks about how that works. So we consider both merit increases and inflation. And as you guess, once you've been there for a while, your merit increases are expected to be lower than the people that are just hired. Yeah.
Does it look historically at the actual merit increases and raises, wage increases for the town of Groton employees, or is it just more industry or market specific?
We tend to look at the town of Groton because it's specific to them. So you can kind of look at that. Again, inflation's broad spectrum, but for salary, the merit increases, we kind of look what actually occurs in the town of Groton specifically.
Okay.
But Ken raises a good point. It might not be a bad idea to do an experience study one of these years, just to see, to kind of refine it. And you can't really, mortality, you need 5 million people to do a mortality study, but the rest of the assumptions like retirement and salary increases and stuff like that, we would have enough data to do those.
Yeah, and you want to kind of look at them to be more specific to your plan, your overall plan experience as well, because different localities could be, different parts of the state could have different rates of retirement as well as salary increases, right? Someone in Fairfield County may be getting higher pay increases than someone in the Northeast Hills of Connecticut, right? Because a more rural area, less jobs, little cost is a little lower up there.
And we do use different merit increases for police and fire than we do for the town and board. Is in the police and fire, if you start looking at those, it's not uncommon for a policeman's salary to go up when they first start 10% from one year to the next, because you got both the regular inflationary increase and a big merit increase with a promotion. So so there's we do have different assumptions for different groups as well.
Yep.
Thank you.
Okay. And next two slides are kind of from a report we put out, a survey report that we look at all the municipalities in Connecticut, the CAFRs, to kind of get a feel for where they are. Again, it lags, the information lags, right? Because right now you guys are completing your 2021 CAFR. So these look at the 2020 CAFR, that's the last ones that are out. And you can see the average long-term rate of return is 6.66%. And that was down from just under, 6.74. I expect this to go down a little more, get closer to 6.5. You guys are right in this, these high bars to 35%, going from 7.25 down to 7. I expect these kind of continue to shift down below 7. I'd expect after a couple more years, most people will be between the 6.5 and the 6.75. Again, unless things change dramatically, right? It's very hard to continue to support rates over 7%. Just because the capital market assumptions that most firms come out with don't support anything that high. You'd probably have to be 100% equities or something to get something that comes out that works out that way. It's good that the market beats it, as these guys had said, both stated. You still having a good year, but realistically, when the accountants, they don't like to look at that, because again, that's short-term returns. They want to look at long-term, what you expect the portfolio to earn long-term. So it's always something to continue to think about where we're at. And this last one is kind of shows you the funded ratio where you guys are at. So you guys are in this 80 to 90%, right? Overall, Board of Ed's a little higher, but so you're still up in the top 40, 30, 35, 40% of them. And I expect when we look at this same chart as of 6/30/21, all these will shift more higher. Just because obviously everybody's measuring at a much higher rate. And again, this is going to be as of market value. So you guys are going to be way up in the 90s, right? As we saw in that chart before, that graph, you guys are at 91% on a market value basis. So looking ahead, right? As I mentioned, with the 7% return, overall, you have that unrecognized gain is going to be expected to be reduced by 4.1 million, right? That's going to be roughly the 25% of that $16 million assets that we're going to expect to realize. So that's good, again, due to the smoothing of the assets, right? So as I said, got that big number built up. We'll recognize 4 million of it next year. So that'll help reduce the contribution sum. Again, that's if no other change, no other gains and losses occur, right? That we know that'll happen. Again, if there's more asset gains, it'll be a little different. You know, it might be a little higher. Asset losses will reduce that a little bit. And this is going to occur for another 3 years. Again, as I mentioned, the Board of Ed is a little bit more better funded. They're 91% versus about 80 for the town people. Again, that's from many years ago, how you guys originally divvied up the assets and what each group is assumed to contribute to the fund, right? We actually do kind of a pretty detailed look at keeping tracking of liabilities and assets for you guys. A lot of them we don't do as much detail that we do, but we kind of look at the exact benefit payments, exact expenses by group and contributions that are coming in. This bullet here, long-term rate of return assumption. Again, we dropped to 7%, and it may not, you know, we may continue to maybe get down a little lower. I don't know. Again, we'll have to work with Seiju and both Ken and Pat and where we're at with that. You know, the basic where the portfolio is and what we expect it to return going forward. I think it's a little lower. It's probably in the low 6s right now. We're seeing, you know, so 7% might be a little high still. So we might have to lower it a little more. But again, that's a conversation to have. And the last 2 bullets are what we're going to talk about next. You know, pension obligation bond. Does it make sense? If so, what amount we're going to use? And then the last one, someone mentioned about federal relief funds that may be available to maybe dump in the pension plan. Does that make sense? You know, and what we'll go do going forward with that. All right. I
Do you
think
have
that's
the-
it. What's that?
Yeah. Do you have the next presentation?
I do.
Stefan?
So I just want to, let's see if there's any questions specific to the
Yep.
valuation first. I know I went through a lot of information fairly quickly. John, anybody on your side?
Steven, this is Mark, and I don't have any questions on the presentation.
Mhm.
And I may have missed it. I know there were some things sent out electronically
Yep.
in the last day or so. But if this was not one of could you send this slide deck out? I know it's in most of it, maybe all of it's in
Yep.
the handout.
Yeah, Lori or Carol has it, but I can certainly, yeah, I'm not sure if I can pull your email up. I probably can, but we can certainly get it to you. We'll get it to the right
Yeah,
people.
you may want to
right?
just send it to everybody. No rush. I just, it's a lot more concise and in my mind, a little clearer.
Yep.
Thank you.
And to the board members, I have determined we are not, well, now Carol has arrived, but we were not at quorum before that. I was able to get a hold of Eileen. Unless there's bylaws out there, I don't know if that override Robert's rules. We're going to need to accept and file this report, but first, I think before we did any of that, we'll need to redo the chairmanship vote, I think, to make sure everything's official, redo the other votes, but we'll come back and do these things after we get through our presentations.
Okay, so I will share the next one. Give me 1 second. Let me open that one up. All right, there we go.
Okay.
Just
Let's see.
Well, tell me where you want to be, Bill, and I'll move along.
Yeah, no, good. I want on that first page.
Here we go. This-
So the introduction says pension bond or large contributions, but the other scenario is just keep things as they are. So you don't have to make a change. Pension bonds. I've heard a lot of people say, well, why would a town with a well-funded plan do a pension bond? And to me, that makes more sense than the towns that are not well-funded. Because the towns that are not well-funded are taking a big risk and they're investing more assets, and those assets have to return a higher amount. So you're better able to take advantage of the arbitrage, the difference between the pension bond interest rate and what the fund can earn with a smaller amount than you are with the larger amounts. I've done some pension bonds for cities where they're borrowing 300 million and they're putting it into the plan, and it makes a big difference. What if that 300 million starts losing money? So then you got to pay back the losses on that as well as what you were paying before. But so this is why, don't laugh if you think, this pension bond doesn't make sense. Large contribution. A few years ago, I worked with the MDC in Hartford. They put $10 million into their plan. It reduced their pension contribution for years. So it was a budgetary thing. It was a, one-time thing that they had, like you guys had. And so it's a good thing to do. So let's go to the next slide here. Oh, this is the one they told me I had to put in. Okay, so let's keep going.
Usually we keep this one at the end.
All right, so now I can't do this stuff, but so the first scenario was, and I want you to keep in mind that all these are assumptions. Up on the top, the 2.4%, that's the inflation and the payroll growth assumption. The discount rate is 7%. We're assuming you're going to return 7% every year. And then we're doing a $10 million, we did a $10 million bond illustration, and we did an $8.6 million extra contribution scenario.
Just to point out, Bill said, we're assuming 7% on the assets, but we're also assuming 7% liabilities, right? So
Right.
for instance, we could, if you ever looked at change, maybe this doesn't earn 7%, how that might impact down the road. We're trying to make it thinking going ahead, what could possibly be asked, if you want to see a worst case scenario, maybe 1 year the fund earns 3%, and what the impact of that. You will still keep that liabilities at the 7% though. So it's just something to kind of keep in mind.
Yeah, so for now, this is kind of an apples to apples contribution. So we've projected that the one on the far left, that if you just kind of keep the course, stick where you are, we're projecting a total of 112 million, 8,000. I can't read the
6,000.
number so small.
112. Yeah, I would just say 112 million.
But we're projecting that the town will pay 112 million over that time period.
Just one thing to point out, because as you see the contribution staying at 5 million, we did not assume the actual value of assets will go up by that 4 million that I was talking about. But we do expect it to happen. But we're just saying, based on, we're just taking the assets as of today and assuming they're only earning 7%, and that there's no unrecognized gains or losses currently. So
the object is all these scenarios are apples to apples. But we certainly hope that you have another good year of the assets, and you contribute, in your contribution is even less than we estimated. So then we did a scenario whereby you do a $10 million bond. And why don't we go to the end of the slide deck here for a second? Yeah. So actually what you do is, and I don't know if Bill Lindsay is still here as well. So Bill, if I'm saying anything stupid, please stop me. But what you're doing is you're bonding 10,303,000. The expenses for the bonding are 303,000. So a net of 10 million goes into the pension plan. So people that work with bond realize that this goes on all the time. So then what Bill Lindsay, boy, he turned around some numbers pretty quick for us so we could do this. And if keep on going back to that,
this one,
the illustration here.
this one or the last page again?
Yeah, go a little bit further. So what? Go down one more here, because I think the interest rate.
This is the last page.
Yeah, these are. I plagiarized these slides. These are all Bill Lindsay slides. Go down another. That's the last page.
Yeah. So you'd want up. This is where the bond payments are.
So it's about 3.09%. I think is the bond rate.
Yeah. For average purposes, so it's in the middle here.
So I think Bill told me to use that one there. The true.
The true interest cost. I'm sorry.
Yeah.
It's the one. It's this one right here. 3.09.
So that tells you what you're borrowing money at, in effect. And so I took all these numbers from Bill and I put it into the spreadsheet. So go back up here. Go back up to the illustration now. Okay, so the second scenario, your bond payments, close to that $700,000 a year. So you'd be paying bond payments back for 13.9 million. Your pension contribution over the time period would go to 188 million, or to go to 88 million.
88.
Yep. And adding the two together, you get 102 million. So comparing the 102 to 112.
Yep. about 10 million savings there.
So it illustrates a nice savings. And then the third scenario is, okay, let's take that 8,600,000 and put it into the pension plan. And so under that scenario, well, you've got the 8,600,000, you've got the pension contributions, and here you're actually paying, a total of 99 million over
Just
that
under
time.
100 million.
So you're paying 100 million. So that's, you're not paying any interest on the bond. So a little bit of savings, there. But you're not putting, you're putting in the one scenario, you're putting in 10 million. In this scenario, you're putting 8.6. So one of the things that it's not quite apples to apples here is that your pension fund would be a little bit better funded under the bond scenario. Okay, than it is under this scenario. Okay. So certainly, the other thing is too, is, when you look at each year, you're talking about the town saving about 784,000 a year, each year over a 20-year period. It's a nice savings. If you page down a little bit, I think I've shown a display, what we've done here.
Bill, sorry, this is Jason Pollard. I just had a quick question. That 8.6 million, is that the COVID relief funding? Is that what that is?
Yeah, that would say, and
Okay.
we could do
It
this.
can be any number.
Put in any amount you wanted, but I started. I was chatting with Ken Hine about this, and you can, whatever you want to put in, you can put in. If you want to do this, so this shows the impact of one scenario, but you've got lots of scenarios. So myself, I always root for the pension plan to get all the money, but because that means it's better funded. But it's not. I'm not spending the town's money.
I have a question.
Yeah.
I just received an updated handout from CCM that says it's still prohibited to put money towards this. Is there a loophole by using that up to 10 million for general services? Is that why you can do this?
What did the handout say?
It says this is prohibited use.
For the
Pension.
8.6 million?
Yep,
Okay.
Oh, really?
yep.
From day
And-
one.
And
Not
from day
something-
one, that's been prohibited. And as far as I could tell, I just got this a couple days ago on the final
What?
rules, and it says it's prohibited.
So we don't want to look at, this is if the town wants to come up with additional monies.
Right.
Basically. Otherwise, you're going to really focus on the bond, but regardless, whether it's that federal money or not, any extra money always works better in the plan than it does out. Obviously you have other constraints and other requirements, town expenses that you need to account for. So it's always a
Yeah.
matter of what makes the most sense for you guys on a budget basis.
So the town has some past service unfunded liability. And right now they're paying it off at 7%. So, that's better than any bond that you have out there. So to put money into the plan, the extra amount that Stefan's talking about, it would certainly be some savings. So good way to, so if you're in the problem where you got extra money and you don't know what to do with it, I haven't talked to a lot of towns that have that problem lately, but if you do have some extra money, it does well in the pension plan. It helps you reduce your future years' costs, and it's a good investment for the town.
It just goes to the pay now, pay later kind of thing. And obviously if you pay more now, it saves you later. But again, you always have to think about what's best for the town, what works best for you guys on a budget basis.
Yeah, this is Mark. This issue came up not with the thought that there's money hanging around somewhere, extra money. This was simply given that interest rates have been so low. And there was an article in the paper now a couple months ago that Norwich has gone down this path. And what got my attention was that their annual savings, the delta between their annual contribution versus what their bond costs were pretty significant. So it wasn't, it's an interesting thought to tap into the COVID dollars, but if that's not allowed, but this was truly if we were able to bond, everybody agreed to do that, the town council and so forth. Would there be savings versus what we think would be our annual contribution? Everything's a projection at this point.
Yeah, so, yeah, well, I mean, we're projecting that they're gonna be savings, but we certainly can't guarantee it.
Right.
And I think you're taking, like I said, a plan that's well-funded like yours. I mean, I did some pension bond work for Waterbury and for Bridgeport. And those pension plans, weren't that well-funded. And they're taking a big risk by borrowing lots of money to true them up. So, it's, you're not taking quite as much of a risk, so you're able to take better advantage of the arbitrage than they are.
And always, one of the things to always keep in mind is when you do bond, that's a hard debt. That's, that you actually have to make sure you are capable of paying each year. Your ADEC, you can short the ADEC on time to time, but you can't short paying the bond payments.
Of course, we're not recommending shorting the ADEC.
Yeah.
Can I jump in for a second? This is Judith Blank from Pullman. If you do issue POBs, you can't short the ADEC.
Right, exactly. You have to,
Right.
you do. That's a statutory
Okay,
requirement.
I wasn't aware. I didn't know that. But just
I did.
good keep in mind. It's just to keep that in mind, right?
Yeah,
Right,
yeah,
right.
exactly.
Because it's hard debt versus soft debt, so to speak, right? Yeah.
Well, right. But the state statute does say once you've turned it into the hard debt, the ADEC then becomes a hard debt too.
Yeah, it's
So
a
you
minimum
do
required.
Give up some flexibility.
Well,
Yep.
the town has an ordinance that also says whatever the actuarial
That they have to.
conclusions are, the town has to contribute on an annual
So there's-
basis.
Yeah, so there's no change there.
Yeah, no change in your policy. then.
Quick question, how sensitive are these numbers to a change in the issuing rate? So if it's not 3.9, it goes up to 4.9, what's the impact on these?
Oh, no,
on
the issuing rate
savings?
right now is 3.09, I think.
Okay, so if it goes up to 4, what's the impact? And then 2, is there a potential impact if it wasn't a $10 million issuance, it was a 20 million? Would there be that much more savings potential as
I
interest-
think, yeah, you got more savings potential and you have more risk. So,
Right.
when you borrow more money. And I don't know how the bond thing works off the top of my head. I don't know if Bill Lindsay's still listening or not. I don't know how. if he
Yeah,
knows it as,
I'm here. No, I'm here.
as a
Bill.
rule of thumb.
Yeah, I mean, Ken's right. First off, they're fixed rate bonds, right? So they're going to carry the same, they don't float. So as rates would go up over the life of the bonds, they're not going to change, but they are subject to fluctuations in the market. So for example, that 309, and when I ran that on the 28th of January is probably not a good number anymore because the 10-year treasury is up 20 basis points since then. So it's probably closer to 329, which would knock about $11,000 off of the annual savings.
So I have a question. That means the interest rate can continually rise?
No, they're fixed rate bonds, and we would fix them at the time of issuance. But when I was asked to run again, as both your investment advisors indicated, we're in a pretty volatile interest rate environment right now. And when I ran the numbers on the 28th of January, since that time, 10-year treasury has increased 20 basis points, 0.2%. So we're, it's moving very quickly at this point. Unfortunately, it would be moving away from you if you were looking to issue, pension bonds.
I had a quick question. This is Jason. If we did bond, this might be for Ken, would we have to change our allocations and how our breakdown is to kind of minimize our risk because we're bonding?
Yeah, exactly. That's a great point, Jason. The answer would be likely yes, that you would, in fact, want to lower that expected return. You'd probably want to go heavier into a fixed income allocation. And so that, has a circular effect to actually increase the liabilities, which actually, defeats a little bit of the savings that you've got there. So, we'd have to sort of work all that through as well.
Yeah, now the two most recent
Conservative.
know about would be the town of West Hartford. And I think they were funding at about 7% interest rate. And they took advantage of this bond issuance to lower their discount rate to 6.25%. And that allowed them to then, as Ken said, that allowed them to change their investment philosophy a little bit, get a little less risky. And you'll see, like when you do a pension bond, the big savings are often in the first year, where the pension bond money is going into the plan, and the town doesn't have to contribute. Because the pension bond does count as a contribution, if you will, to meet the ADEC. Also, the borough of Naugatuck. Well, the other thing that the town of West Hartford did is they said, okay, we would have had to put in 20 million. I don't know what the number is off the top of my head. We would have had to put in 20 million if we didn't do this. So we're going to set aside 20 million in a reserve fund. And in case things go bad, then we put that in. So they put that in their filing. The state was very happy with that. The state approves the filing, even though, and it's my understanding that you can go ahead without state approval anyway, but it's good to get state approval. The other entity that just did this was Naugatuck. Yeah, go ahead.
I was going to say, if
I think
when you finish,
earlier, it's not.
when you finish, to John, when Bill finishes his comment on Naugatuck, I have a case study in my presentation on West Hartford. So since questions are kind of heading us in, I think, in that direction anyway, if there's no more questions for Hooker and Holcomb, maybe we could switch gears and I'll run through my presentation, which is, we've got a couple slides on.
I do have one quick question. Just following that spreadsheet that you had up, I saw fiscal year savings for the 8.6 scenario. Is there an equivalent column or a total savings for the 10 million bond scenario, the fiscal year savings?
I didn't put the column in, but you're looking at what is it, about $10 million?
Mhm.
Yeah,
Yeah.
I wasn't sure if I could compare it to the
Yeah.
112 to get that amount.
Yeah.
Okay.
Yeah. So, and the other thing, before Bill gets into West Hartford, Naugatuck, what they did is they didn't want to create a reserve fund, so they just lowered their expected rate of return to 6%. They just said, we're doing that, and they don't want to do all that reserve fund and all that type of stuff. So that was their take on. So those are the two most recent ones that I know of that have been gone through.
Great. Bill, you want to go ahead?
Sure. So, all right. So good afternoon. My name is Bill Lindsay. I work for Municipal Services. We are the town's financial advisor for debt issuance. I personally worked with the town since 2008 as the town's debt advisor. So I'm going to share my screen here and just kind of walk you through a presentation that I put together. And really going to focus on financial and credit implications of doing a pension obligation bond. Bill talked a little bit about maybe the savings associated with the contributions, but there's a few other things that I think you have to keep in mind. We started to touch on them with respect to the town's policy and state statutes regarding the issuance of bonds and what is required of the town if they were to do that. But I also want to talk a bit about the credit implications of a pension bond. And we were the financial advisor for the town of West Hartford when they did their $300 million pension bond last July. So I've got a number of slides at the end in a bit of a case study, so we can walk through some of the specifics and get, help you get an understanding of some of the mitigating, the credit mitigation strategies that they undertook to help them preserve what is their AAA bond rating. So I guess, what I wanted to just first touch on is, what really is a pension bond? They're normally called, they're euphemistically called pension obligation bonds, but they're really rarely obligations of the pension fund. They are obligations of the plan sponsor. Okay, so it would be the town of Groton would be issuing the bonds, and the security to repay those bonds is typically general obligation pledge of the town. So the town's full faith and credit. And that's what we've seen, used most frequently in the state of Connecticut for other local government issuers who've issued pension bonds. And as we talked about, pension bonds at their core are an arbitrage play. So you're hoping to borrow at a low cost and then reinvest the proceeds at a higher rate than the cost you borrowed at. But as Stephen alluded to, there are risks associated with this, and the single biggest risk is hardening of that liability. So you're taking what would be considered a soft liability and recognizing the town's ordinance that says they have to fund at the ADEC. But under state law, you're not required to fund at the ADEC, and other issuers who don't have a similar statute or ordinance to the town requiring 100% funding of their contribution. It's an even softer liability. But by issuing bonds to fund your plan, you've now taken on a debt obligation that you would need to meet every year or be in default. As I said, they generally are issued as GO bonds or general obligation bonds, but they need to be issued as taxable bonds because the purpose of the issuance is for arbitrage purposes. So they're not tax exempt. It's a higher rate, roughly 75 to 100 basis points higher than what your normal borrowing cost would be on a tax exempt basis. So that helps. That's something to keep in mind, because it does eat into what those potential savings would be on an annual basis. So now kind of switch gears and talk a little bit about some of the credit implications. I think one of the things that's important to keep in mind at the onset here is that pension obligation bonds or pension bonds in the market, are not without controversy. So there's a lot of guidance out there from both the credit rating agencies as well as the government finance officers of America. And most of that guidance says it's really not a good idea for state and local governments to issue pension obligation bonds. They consider it very risky, and there's a number of high profile bankruptcies that have been accelerated or where pension bonds have contributed to the decline of the issuer and have ultimately led to bankruptcy. So, the city of Detroit, Commonwealth of Puerto Rico, Stockton, California are three, high profile bankruptcies that were a direct result of high pension costs and that were exacerbated by the issuance of pension bonds.
And let me make a quick comment if I could, Bill. What happens is, when you're talking about the arbitrage, you might be thinking, okay, I'm assuming, 7% interest. And if I return anything over the 3.09% bond interest, I'm good. But that's not necessarily the case. So, and one of the things that I've studied with Bridgeport, Waterbury, and in some of the towns and cities that are borrowing a lot of money, is I found in those situations, when we did it for Waterbury, it was a few years ago, they were actually at 8.5% interest for assumption. And we found that they had to return at least 7.75% overall, or they were going to end up paying more money by getting the bonds than would if they had done nothing. So you don't get the full arbitration amount that you were thinking. And I can't remember what the bond was for Waterbury. Do you remember that, Bill, or any idea? I was going to say maybe 6% or something. It was because the rates were higher back then.
Yeah, I don't know. I'm sorry, Bill. I could look it up, but they weren't our clients.
Yeah.
So I don't recall off the top of my head.
Right. And I just did another one and if you borrow a lot of money, usually you can't be the full arbitrage amount, but because the town of Groton wouldn't be borrowing that much money in relation to their current assets, they could get they'd have a lot less risk than some of these towns that are, and that's why I don't think it makes sense for the towns that have a poorly funded plan to do this. Because as Bill said, that put a few of them under. Because what happens now, you have more assets than what you did before. And if those extra assets are starting to not return what you think, then you've got extra contributions on that part, plus the other part, and you end up paying more money by doing the bond than had you not done this. And you might only have a spread of 75 basis points that you can use for an underfunded plan. But a plan that's well funded, maybe you can use a spread of 2 to 3%. So you'd have a lot, a lot less risk than some of the towns and cities that are not well funded.
Right. And the other considerations, I'll talk about the different kinds of risk, kind of try to categorize each of those risks a little bit, goes back to what Judith had said about state statute, right? So the idea here is, yes, if you're borrowing at 3%, let's say, and your current discount rates at say 7, that we've got a pretty healthy spread there in order for the town to make, in order for the town to have positive economic results or savings. But the problem then becomes if a plan returns 6% and we fully funded it, and now it's no longer just the normal cost, you start to develop the other portion of your ADEC that Stephen mentioned, is that past service contribution that starts to accumulate. You have to fund that statutorily as well. So now you've got 2 fixed costs in your budget that are the debt service, which would not be changing, but your contribution will continue to go up, and that would eat into the potential savings you had, the savings that we were looking at previously. And that loss of budgetary flexibility is a major concern of the credit rating agencies. Okay. So, generally speaking, for the credit rating agencies, they view pension bonds as being either neutral at best or negative to an issuer's credit profile. Right? Almost never are they considered a positive. And that's really a function of the various types of risks that the rating agencies have outlined, which I'm going to touch on next. Right. So, the degree of the impact that a pension bond issuance would have on an issuer's credit rating is going to depend on a couple of things. The size of the bond issue relative to their, your current debt load. So how over leveraged or how leveraged is the community already? And are we piling on additional debt on top of that, which would just, make them over leveraged and reduce their flexibility going forward? Would that potentially crowd out other borrowing needs, other capital needs, roads, bridges, schools, et cetera, that you may otherwise have to, pay for, and you've utilized that borrowing capacity up to fund the pension plan. One of the other big considerations is really the rationale for issuance. They tend to look negatively if this is a quick fix. Bill mentioned, the idea that some issuers may not make a contribution in the year of issuance, or maybe the year or 2 following issuance. If that's really an issuer's motivation, is to have a couple years of budgetary savings, and then worry about what the savings is down the road, that's not going to have a positive impact on their credit rating at all. They prefer it to be part of a more comprehensive approach to addressing the pension liabilities. And I'll talk about some of the examples of that in a minute. But things like, things like, is the plan remaining open? Are you switching to a hybrid plan? Are you making negotiating changes with the labor unions with respect to multipliers, with respect to age of retirement? Those types of things that will reduce the liability on the back end. If this is done in connection or conjunction with those types of efforts, then it's considered part of an overall strategy, and it's viewed more favorably. And then finally, what are the underlying assumptions that go into the plan of finance? So Bill talked about discount rates. Are you reducing your discount rate? Or is the discount rate staying the same? How are we structuring the bonds? The statute, which Judith has, I think, some information on in a little bit, talks about there are certain requirements that in structuring a pension bond that you have to meet. The state doesn't want issuers to get into financial trouble, so they've put some guardrails in place to make sure that you can't backload the debt, you can't defer the payments for multiple years. They want to make sure that you're doing this, and because they're, because again, it does carry a higher amount of risk, associated with it. But those types of underlying assumptions are things you would have to explain to the credit rating agencies, explain the rationale, explain the due diligence process you went through, how you came to those assumptions, because those will be the questions they'll be asking. But really, to try to frame the risk ideas, the risk concepts here, again, hardening the nature of the liability, as we discussed. Really, they break the risks down into 3 kind of buckets, if you will. Budgetary risk, default risk, and then what they call loss of financial flexibility. So first, budgetary risk. This is related to what you were hoping the future savings would be on the contributions. If they don't materialize, You don't make your rate of return assumption, and now your annual contribution starts to increase. So that's one of their primary concerns. And as Bill rightly mentioned, issuers who do issue pension bonds, they are increasing their exposure to pension asset risk. So that's the primary concern. But then there are more secondary concerns. Because we are hardening the liability, and this is a bond payment now, there is an increase in default risk. And defaulting on a bond payment would lead to multiple SWIFT rating downgrades as a result. So it's not something that people should take lightly. And then the final thing is, which I touched on a minute ago, just loss of financial flexibility. Both in terms of the state requirement that you must fund the annual contribution going forward, the recommended contribution going forward. But again, does this borrowing crowd out other needs of the community, right? So do you limit your ability to borrow for other capital projects going forward? So there are some potential mitigating factors or efforts that people have taken, and we'll talk a little bit about West Hartford in a moment. But some of the things that are viewed favorably when a pension bond issuance is part of a larger comprehensive plan, what kind of steps can the community do to help solidify their rating? And so some of these I mentioned, are they keeping the plan open, or is the plan being closed? I know in the state of Michigan, one of the requirements for issuing pension bonds is you have to close the plan. And if you don't close the plan, you're not statutorily permitted to issue them. Or are you creating a hybrid plan? Are you moving in that direction? Are there negotiated changes with the credit, with the unions to help reduce the liability? And then the one thing that Bill mentioned, and we'll talk about a little bit in the case of West Hartford, is the concept that the West Hartford kind of came up with, and I know Norwich in their issuance, their plan of finance is doing a similar thing, as they set aside an amount of money in a reserve fund that they, by ordinance, restricted the use of, and said, listen, we're going to set this money aside to use in case our contribution increases in future years. In the case of West Hartford, they set a parameter. If it goes up by more than, I believe it was 5% in any one year, then they would be able to draw down on this reserve account. And they did some statistical analysis and probability analysis and determined what the likelihood of that would be over the 25-year life of the bonds. And they only determined that there was a 3% probability based on a number of 10,000 iterations that they ran, that they would need to draw that down in its entirety. So that gave them a degree of comfort that, hey, we've got a strategy in place that's going to prevent the number going up and negatively affecting the budget. So some common mistakes for of pension bond issuances. Again, we mentioned GFOA, the Government Finance Officers of America, is their best practice is very direct and says they don't believe local government should issue pension bonds. But where we've seen a problem, and Bill touched on this a little bit, is often they're issued by distressed communities who maybe don't have the best of motives in doing so. So and if they're issuing a large amount of money and they have adverse returns, or they don't meet their discount rate, now their contribution starts going up. It could have a real negative effect on their budget and then their overall financial health. Where we've seen people who've issued them when they're in a situation where they had to issue them at higher rates, and that spread between the borrowing cost and what their discount rate isn't a favorable spread. That's helped contribute to a loss of financial flexibility and then a decline in their financial health. If they have too aggressive growth assumptions, or the discount rate's too high, frankly, that's been a problem meeting that as well. I will say, and Bill touched on this, is that you do have to go to the state and to at least notify them of the issuance. It's not an approval per se. They don't have the ability to tell you no, but what they will do is they'll make recommendations on your plan of finance And those recommendations need to be disclosed to the bond market when you sell the bonds. And, I've been through 3 of these, and each time the state has asked the issuer to consider lowering their discount rate further than what they had come up with through their modeling. And so I think it's a pretty safe assumption that they would, in the case of the town, at a 7% discount rate currently, they would be recommending a lower rate. And as Bill mentioned, West Hartford went from 6.99 to 6.25 when they did theirs. And then I get the final common mistake is not really having just any kind of backup plan in case there are potential increases, due to low market returns. If those going to flow right to higher contributions, and then ultimately the budget, that loss of financial flexibility, that's really what the primary concern is.
Bill, is there a kind of a line drawn in the sand where the rates are favorable versus not favorable? The spread?
I don't know, Bill. I mean, I think 200 basis points is in my mind what that number would be. I don't know what your experience has been.
Yeah, the ones, can you hear me now? I don't know if I muted myself or something.
Yeah.
The ones I've been working on, they've been poorly funded plants. They borrowed a lot of money. So they only had 75 basis points of spread to work with. And so in other words, if you're going to borrow, if you say you're going to lower your discount rate to 6%, that means on your pension bond, you better earn at least 5.25%, or you're going to be paying more than you would have otherwise. The town of Groton, because the amount that they're borrowing would be relatively small compared to their current assets, they'd have a bigger spread than that 75 basis points. It might be 200 basis points. I didn't run it, but it would certainly be bigger than the 75 basis points for a poorly funded plan. I've seen that in a couple of plans that weren't that well funded.
Yeah, and then start talking about West Hartford here in a little bit, but we were assuming 300 basis points through the approval process. So when we went to West Hartford, didn't have to go to the voters, just by the nature of their manager council form of government. But when we went to the council and we had public hearings, we were assuming 300 basis point spread, and they actually came in better than that. But it was more like 350. But that's what the target we were looking at. That's what we really ran the numbers based on.
So what was the bond issue rate for West Hartford?
2.5. It was 2.54 is what they ended up doing. That was that was July of last year.
Yep.
Okay. So, in the case of West Hartford, West Hartford, had roughly a $300 million liability. It was less than that when they were at 6.99, but they, as part of the plan of finance for this, we're going to reduce it. And they, that was a fundamental assumption that went into the plan. So knew that the liability was going to increase. They were about 48% funded in their plan prior to issuance. And the 20-year projection on where their contributions were going to go, they really weren't making much progress in the first 10 years. And the funded ratio really wasn't rising materially until they got after, between years 10 and 20. And so that just, in their minds, it was they were going to be subject to market risk, subject to having that contribution continue to grow without having a commensurate change in their funded ratio. And it was a concern from a credit perspective, and it was a concern, quite frankly, from a budget perspective. They wanted to find a way to try to mute what were consistent increases. Part of the consistent increases in their contribution, as Stephen alluded to earlier, was they were systematically reducing their discount rate. So that was growing the liability and then therefore growing the contribution or the ADEC. And so that was a concern as well. And so this, that from those conversations got into this concept of the pension bonds. They actually started looking at it back in 2018. And did have some public hearings and council educational meetings in February of 19, but the interest rate environment then really wasn't as favorable as they would have liked. And it took unfortunately the pandemic to calm and the Federal Reserve to lower rates, lower the discount rate. and the interest rate environment improved for them. Then we picked it up back in late 2000. So they went to their town council, had public hearings and council meetings in January 21. They adopted their pension bond ordinance and this pension reserve policy, which I'll talk about in a minute, in January. And then we ultimately went to market in July. One of the things that they were able to do is that because we were issued right after the start of the fiscal year, they had, budgeted for a $27 million pension contribution in that year, and they kept that in the budget, despite the fact that we were working towards the pension bond issuance. We issued the bonds, and they considered the deposit of the bond proceeds, which was $324 million roughly, into the plan as a contribution. And they in turn took that $27 million that they had budgeted, and then they set it aside in this reserve fund that I talked about, where they had an ordinance that limited what the potential uses would be. And basically the intent here was to say, listen, if the annual contribution were to change by more than 5% in any one year, we could take that amount out of this reserve fund and use it for budget relief. And that was very well received by the credit rating agencies and by the market. They structured the bonds as level debt service, so similar to the scenario I gave to Bill and his numbers, to make it more predictable from a budgeting perspective. So it was level payments, kind of like your home mortgage. We chose a 25-year term. Again, we did some modeling, and that was kind of the sweet spot. You can go up to 30 years by state statute, but this was a little more conservative assumption. Again, well received by the rating agencies in the market. As we stated previously, they did drop the discount rate from 6.99 to 6.25. And that was contemplated in the sizing of the issue. We calculated what the liability was going to be, so we funded it to 100% based on the lower discount rate. And there was a question, I think, from Ken earlier about asset allocations. They did change their asset allocations to become more conservative. It was a lower allocation towards equities and a higher allocation to fixed income as part of this. And then finally, what they did was, rather than take the 300+ million and drop it in on day one, they did a dollar cost averaging approach over 6 quarters, where they put in 1/6 of the proceeds into the plan, and then they invested it, in fixed income for those other remaining quarters to be conservative, really trying to preserve the principal. That was factored into the plan of finance. Knew that first year and a half or so was going to have a drag on their overall return as it relates to the discount rate, but they felt like they had the proper asset allocation and make that up over the next 24 years of the bond life. Concerns that were specific to West Hartford. So again, that loss of budgetary flexibility was a big concern. We were doing this in the middle of COVID, and so that was a concern. What were the state's contributions going to be? Did they have to change? Obviously, with the federal stimulus monies that had come out, that ended up not being a big concern, but it was a point of conversation with the rating agencies. The town of West Hartford already had what they considered a moderate debt burden or debt load going into this, and they are part of MDC. So when you factor in the large capital project going on at the MDC, they're actually are termed to have an elevated debt level. So to bring on this additional $300 million of debt was something that was a concern that we had to address. And quite frankly, West Hartford, as it relates to some of their peers in Connecticut from a credit rating perspective, specifically lower Fairfield County communities, they do have a slightly weaker credit profile. They're not as wealthy. Their fund balance is not as high as some of the Fairfield County communities. So that was something that again, we needed to be prepared for going into the rating discussions. I think we talked about the mitigating strategies here already. Again, the important thing was this was not a one-off for them. They'd been making changes to the pension plan for the better part of a decade, and trying to limit the liability more on the back end by changing the benefits. And so this was, we framed this as just another step in that process. And I think that was very well received. And then, finally, ultimately, they were able to keep their AAA rating from both Moody's and S&P. they both rating agencies noted that, going forward, they were going to monitor the returns and whether or not that led to pressure on the budget. But going into it, S&P in particular felt that the town had done their due diligence, that they'd come up with strong mitigation strategies to help offset those potential risks, specifically the pension reserve. And so they were ultimately able to maintain their ratings. So that's what I'd put together on pension bonds. I don't know if you want, John, if you want to have Judith just speak to the the statutory framework or the other
Yeah,
questions
Judith.
now.
I have one question for him.
Oh, Cindy has a question for you, Bill.
Bill, how much did you say West Hartford's annual contribution to their pension plan was?
It was
Before
27,
this?
yeah, 27 million.
It was, so they did budget 27 and that's what they took and moved into the reserve fund.
Yes.
Okay, I just want to make sure I heard that right.
Yeah,
Yeah, and we're
and
only 48% funded.
yeah,
too.
it's a sizable contribution, but it did require a certain amount of fiscal discipline on their part. Could have easily not budgeted that, right? Taken that out and said, right, we're going to get $27 million of tax relief in year one. But I think they were taking a more long-term view of this and wanted to find a way to offset the risks that we, the credit rating agencies had articulated, and how do they maintain that AAA rating? And I think that was a big piece in maintaining their rating.
Bill, may I ask a question? If West Hartford got this bond, now did their town also contribute annually?
Historically, or
No, that, from the time they got this pension obligation bond, did the town of West Hartford now stop giving their annual contribution?
No, they did not.
That's all
So
right.
there again, the statute requires them to fund the actuarial determined, I'm gonna put it in air quotes, contribution that the actuaries calculate. For them, the past service contribution portion of the went away. So that but they still had to pay the normal cost, which is about 7 million. So it went from 27 million to 7 million. And so there was but we filled that $20 million gap with about $18 million of debt service annually.
And
So
the other question I have is this federal and state taxable? The bond?
It's a good question. I believe it is. Or is it exempt for state?
I expect it's exempt under state law, that the loss of federal tax exemption has to do with the use of the funds, and state tax law does not contemplate that. So I think it would be exempt under state of Connecticut taxation requirements, except for certain ones about franchise tax.
But there would be federal tax.
Yes, to the bondholder, yes, definitely.
Bill, what did you say the percent funded was for West Hartford before the issuance?
48.
Okay, we'll go ahead and Judith, did you have anything you want to go over?
Quick question, John. Bill, the 2-year time frame from concept to issuance for West Hartford, is that the normal time frame of the process to go from concept to actual funding of the bond?
I would say, yeah, it's about right. It could be done faster. Judith's going to speak to this in a minute, that the statute has a number of requirements and timeframes with regard to the state review. But there's definitely an education process for the elected officials as well as the public that needs to be contemplated. And, in the case of West Hartford, they went through that twice, as I said. So it could probably be done quicker, but it's not something that's a 6-month proposition.
Gotcha. And the follow-up question is, I think you said the rate gets set at issuance. What is defined as issuance? And then can you lock in a rate 6 months before issuance or?
Conceptually, yes, you could. You'd have to pay a spread on that. For them, it was a favorable interest rate environment. We were assuming 3% all along. We came in at 254, so we had some cushion in there. So we priced 2 weeks prior to closing, So, if that answers your question, I mean,
Yeah.
the problem would be like in this particular environment, the spread that you would have to pay to an investor to lock in a rate with the rapidly rising interest rate environment, could be punitive, really. So,
Yeah. Okay, thank you.
Yeah, just speaking as a West Hartford resident, I can tell you that the notion of the neglect of the pension funds was being spoken about 15 years ago. So this was something that, people knew there was a problem building, or anybody who chose to pay attention knew that. So, this is a very different situation here. And Bill alluded to the process, and it's pretty straightforward. It's just time consuming. I mean, first of all, you have to go to referendum as you would for any other bond ordinance in the town, in Groton. And then you have to collect a big pile of paper and documents and submit them to OPM and the treasurer's office. And then they will come back to you with a request for another big pile of documents. And then they will give you recommendations, which, as Bill said, you have to present in your official statement. And they are essentially what the recommendations and the warnings almost are what you've heard today from Bill largely, and from Bill and Bill. You do lose flexibility, and that's what they'll point out to you. So the one thing I would add to the conversation is just that you take into account the administrative headache that this will produce, or the extra administrative burden that this will place on the town staff. And certainly when you do a regular GO issue, it's just a lot of work. You're doing a disclosure document, you're getting things ready for market. This is probably triple that type of work. And then there are ongoing reporting requirements to the state. So that's just something you should factor in there in terms of, weighing your decisions. And as Bill mentioned too, Bill Lindsay mentioned also, you will have to educate your elected officials on this, and the voters.
The other thing that I'll mention too is you probably wouldn't want to borrow much more than the 10 million anyway. Because right now, although when we did the valuation, the unfunded was 30 million, on a market value basis, the unfunded is only 14 million.
Do you have any more questions?
I just have a comment. I think my biggest concern is what effect this POB, as you're calling it, would have on other projects. If we had other projects in the town that needed to be funded, I thought I heard someone say that this might, have a negative effect on that.
Well, with our school bonds out there, and
yeah, I mean, if we're in the neighborhood of $12 million, Bill, we ran it at 10, but Bill said it might need to be a little more than that. Possibly not, but with the school program, your internal policy is I think the limiting factor here. It's not a statutory issue. You're well below your statutory borrowing limit, but you have an internal policy that limits the amount that you can borrow at 50% of that. And we're coming close to that, to be honest, with the school program. So it's something that would definitely need to be examined and modeled, especially considering what would be in your capital plan going forward. And now that the school program's wrapping up.
and also, I don't know if anybody's watched our council meetings, but nothing will go to them anytime soon for even start discussions. Now myself, I'm open to keep discussing it, but I don't lean towards it. What do the board members think?
And this is Jason. I want to thank everybody. I mean, you educated us quite well. I mean, it was very clear and really put a lot of good information out there. So I want to thank you.
Good comment. Thank
And
you.
John, this is Mark. I mean, I do want to thank you and staff and certainly all of our advisors for the information. I'm not, I certainly understand Groton fairly well, and I can't even imagine having this discussion with the town council, to be very honest with you. And it is, in fact, it's the it's not the board. The board can represent to the council or suggest to the council, hey, this is something you may want to consider. And I do think it does warrant some consideration. I mean, I've heard a lot of warnings and a lot of negatives, and I've heard that we're going to lose flexibility. We don't have any flexibility now. Okay, whatever the actuarial assessment says is what the town has to put in. Now, whether or not they could undo that, I don't even want to think about going down that path. But there is an ordinance that says they are obligated to meet that actuarial obligation. And so to me, this isn't really any different in my mind. I will admit, and this is maybe more for Bill, because Bill was very patient with me when I was manager, along with others, talking to us about our bond rating and this and that and whatever. And for the life of me, I cannot even imagine how a community like West Hartford could have a AAA rating when their budget is only, or their pension is only funded at 40-something%. I am shocked, absolutely shocked. And so I'm like, to me, West Hartford is one of those communities in the state. I mean, the Gold Coast has no relevance to southeastern Connecticut. West Hartford does. The Hartford area, the Newingtons, the Wethersfields, and at least in my mind. So I'm shocked at that. And so I do, I was simply looking at this as, if there's a way of borrowing money at a lower rate, then what that effectively creates annual savings going forward, not the first couple of years, but for the next 10, 15, 20, 30 years. And granted, everything, there's a risk in everything. The stock market, it's not like our pension fund, there's any security right now. I mean, the market could go south. We could lose tens of millions of dollars overnight. So it's not like we don't have some exposure now. And to me, it was, I'm sorry for the feedback. I like kind of one of the tables early on that showed the anticipated cumulative savings over time. So whether or not the board wants to keep this on their agenda for further consideration, I almost have the sense, we're a little bit late to the dance, given where interest rates are going, that this was something that possibly in retrospect, we should have started talking about a couple of years ago. And maybe at staff level, there was some discussion. It wasn't something that the board got involved in. But I do want to thank everybody for providing this information. I think it was very helpful.
Yeah, very much appreciated. So we'll kind of keep it on the table somewhat, but kind of track and have some conversations. But I don't think there's any chance of getting it through the current council. I think rates will be totally different by the time we would do anything, but not to dismiss it out of hand though. Can we jump back and do those votes to make sure we're all legal and everything? Let's start from the election of chairperson, and then if anyone has to leave, feel free. For our guests, again, we all appreciate it very much. We'll see you next time. Election of chairperson, vice chairperson, and secretary.
Yeah, I'll make the motion again to keep the same chairperson, vice chairperson, and secretary.
Do we have a second?
I'll second it. This is Mark.
Any discussion? If not, all in favor say aye.
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 Aye. Thank you. That passes. Approval of minutes.
So moved.
Second.
Carol, second. Okay. All in favor say aye. Aye.
Aye.
Aye.
Authorization of payments from retirement fund for retirement benefits. For all
As we've
shown.
done in the past,
Right.
done in the past, I'll move them all as a group.
I'll second it, Jason.
Any discussion? If not, all in favor say aye.
Aye.
Aye. That passes. And then we also need to accept and file the actuarial valuation report.
This is Mark, so moved.
Do we have a second?
Second.
Yes, Jason, I'll
Carol
second.
Or Jason, yeah.
Okay, any discussion? All in favor, say aye.
Aye.
Opposed, same sign. That also passes. Does the next meeting, May 12th, still work for everybody? At our usual, back to our usual time?
Yep.
Okay. We will do that.
So real quick, John,
Mhm.
so everyone's gonna have to make every meeting now to have a quorum unless we
Yeah,
get
we
more
need to-
members,
we're-
correct?
Yes, but we need to step up and be more aggressive on trying to find people. We'll start advertising out more and reaching out more to people. We'll try to kick that in the butt and try to find somebody.
John, do you anticipate the meeting will be virtual again, or are you going live in person?
You know, even if we'll keep, I think for now on a minimum, we're gonna do hybrid. So so either way, there'll be a virtual option. There's a good chance might still do virtual. Outside of council meetings, I don't know about other people. I like the virtual meetings. What do other people think? I mean, at least a hybrid though.
Sounds good.
So John, you mentioned that earlier that you had reached out to Eileen and she got back to you. Could you share with us what her
Yeah.
words of wisdom were with respect to a quorum?
She looked at, first of all, she looked at the ABC book, which we have 6 members. She just double checked that that's what we have. The only way it's overridden is, I'll read you exactly what she wrote, okay? If the
Okay,
bylaws for the board don't specify a quorum and there are a fixed number of members, i.e. 6, then per Robert's 12th edition, section 40.2, parentheses 4, the quorum is a majority of all the members. Whether the fixed number is 6 or 7, the board would need 4 to constitute a quorum. So unless there's bylaws, we can't, and Lisa looked for bylaws. I don't know of any bylaws for this group. Do you, Mark?
geez,
At
I
least I couldn't
thought
find
we
them in the
had some,
files. What's that?
I thought we had some bylaws, John, but let me give
Well-
that some thought.
We'll keep looking to see if we find any.
As I mentioned to you earlier, or mentioned to the group, I mean, this came up before, and I will, at least my recollection was we were getting different advice from the town clerk than
And,
my interpretation.
And Lisa
So,
looked back, there was a couple of years, this happened like in 14 and 15, and it was, used the 3 or the, 50% mark was used.
yeah, I'm just wondering if there's anything we've done that recently in the last couple of years that is important that we go back and redo if we didn't have a quorum of
We'll take a
4.
look at that, right? Is there a time we didn't have 4? I don't remember a time since I've
No,
been here.
because this is the first meeting without Dennis.
Yeah, Dennis usually, I don't
Yeah,
think
but there's
since I've
been-
been here, we'll double
There's
check,
been
though.
times when
Good-
Dennis wasn't able to join us
Yeah.
though, so just to be sure.
Yeah, we'll double check for sure. Good point. Can you, have
Yeah,
Laura look at
Ask
that?
her, yeah.
Yeah, we'll have Laura look at that. If nothing else, I'll entertain a motion to adjourn.
I'll second, Jason.
Who was the first? I
I'll-
missed
I'll first.
that.
I'm sorry, everyone, I was late. I
okay.
apologize.
It worked out. Okay, all in favor, say aye.
Aye.
Aye. Thank you, everyone. I'll see you on May 12th, and we
Take
will
care.
advertise the open positions. Thank you.
Thanks.
All right, have a
Bye.
great day.
Have a good day, everyone.
Be well, everyone.
You too.